Welcome. It is extremely exciting to see the Robertson Auditorium this packed. Can we get a quick round of applause for the Wolverine Crypto Trading team that's put over 100 hours in prepping? To get started tonight, I'm going to lead you with an introduction and Crypto 101. We're then going to go into 10 cryptocurrencies presented on by those guys over there in the quarter zips. And then we're going to finish off with a networking session, which is going to take place outside of these two doors. We'd like to start off by thanking our supporters. The Ross School of Business is gracious enough, and we really appreciate that they let us use this auditorium, as well as has two different fintech initiatives. They're sending some students to London over spring break to go work at Google's office, the Alphabet FinTech office, as well as they started a class to teach cryptocurrencies and blockchain to students. The Zellery Institute for Entrepreneurial Studies is here in Ross as well, and they've been really helpful to the Wolverine Crypto Trading team. Finally, Michigan FinTech, led by Rishi, is a student-led organization that's open to all undergrad students. Please check out their website if you're interested in learning more about FinTech. Wolverine Crypto Trading is 16 undergraduate students. We focus on education about cryptocurrencies and blockchain. Our method is action-based learning here at the University of Michigan. And we do this action-based learning, which for those that are familiar with the Ross School of Business, is a slogan of sorts. We do it in three ways. The first way is by weekly team meetings where we teach each other about blockchain and cryptocurrencies. The second way is by monthly open events to the community, like tonight. And the third way is by trading $1,000 per student from our fund in cryptocurrencies throughout the semester. So these students over here are actually trading cryptocurrencies. Now, can I get a show of hands? Who's an undergraduate student? Looks like most, yeah. Let's break that down into undergraduates, freshmen, and sophomores. Wow, that's a lot. And juniors and seniors. How about graduate students? Awesome. Any PhDs in the crowd? Hey! Members of the Ann Arbor community. I see you out there. Welcome. If you'd like to join the Wolverine Crypto Trading team, unfortunately it's only available to undergraduates here at the University of Michigan. But if you'd like to join us, our application closes tomorrow night at 8 p.m. Please visit our website for more details. This style is going to be a crash course. So we are going to be very fast-paced with information thrown at you. It's going to be information intensive. So if you're taking notes, I hope that you've had plenty of strength in your arm because we're going to be going very quickly. And finally, the goal is exposure to new ideas. So if we go over 50 new ideas and 15 of those resonate with you, and then you go home tonight and Google 2 to 3 of them, that's a successful event. We don't expect that everyone will pick up on all 50 ideas that we present tonight. Crypto 101. Let's talk about the history of money. So in 9000 BC, we had a barter system where we would trade goods and commodities for other goods and commodities. And that worked until we wanted to transport them more easily. So we minted coins. And the early coins had a hole through the center so that you could wear them as a necklace. And that worked at 600 BC until we decided that we need to carry more at a time. And seashells and coins weren't quite sufficient for our needs as money. So we introduced paper. And the first evidence is in China at 900. And as many of you know, we didn't stop there. We introduced forms of debit. So these are checks and traveler's checks. For those unfamiliar with American Express, you would go into one of their local offices, deposit cash, and they would give you certificates. As you traveled, you could then use these certificates so you didn't have to carry huge sums of cash with you. Logical, right? Except we thought that there might be a more efficient system 7 years later. And we switched to a digital form, credit cards. Now you don't even need to carry paper slips with you. Is this the last form of money that we're going to have? Is the digital form of credit card? The Wolverine Crypto Trading team thinks probably not. We probably are going to go to another evolution of what we think of as money. There's a chance that that could be cryptocurrencies. We all know that that's very unclear. There is no set future, and time will tell. Let's talk about what a cryptocurrency is. Crypto is short for cryptography, And currency is short for money that we use to pay for goods and services. But we can't use Bitcoin today at Kroger or Walmart or any other places that you shop. So cryptocurrency is not the best word to describe the 10 different things that we're going to be talking about today. Well, how about we give you a better word to use? Digital assets. An asset is a store of value, and in this case, it's going to be a digital store of value. There is no physical representation of any of the 10 digital assets that we talk about today. Now, for those computer science students out there, you might be familiar with the double spend problem. When we give a $100 bill to a friend, we no longer have that $100 bill, right? But with digital files, we can duplicate a song and send it to a friend. And now we both have a song. This doesn't work if you want to have some kind of digital version of cash. And up until Bitcoin, there was no solution for this. We didn't have a way to prevent duplication. Can you spend the same Bitcoin twice? I think we would all say no, else the whole concept wouldn't work and it would have never taken off. So how does Bitcoin prevent this? And the answer is blockchain technology. I'm going to go through the fastest explanation that you've ever heard of blockchain. Thanks to the Harvard Business Review. It's an open, distributed ledger that can record transactions between two parties efficiently and in a verifiable and permanent manner. Now, those are a lot of words, and yet this is the simplest way that it's been written in one sentence. It's a way to store data. Let's talk about decentralization. So a central model, we have one leader who makes decisions for all participants in that model. We can think of this like the encyclopedia company, Britannica. They would decide what to publish in their articles within their encyclopedias, and then libraries and the Ross School of Business here, for example, would buy the whole set. And Britannica got to decide what information was in those books. In a decentralized model, we don't have one central authority. Instead, we ask the community to contribute. And I think we're all very familiar with Wikipedia, which was this form. And early on, people said you can't trust the information on Wikipedia, right? We all remember our middle school teachers telling us not to use it. That changed over time as the content improved. At the time of Britannica's last publication of an encyclopedia in 2012, they had 65,000 English articles in their books. Wikipedia at the same time had over 4 million and was growing faster. Now, okay, we've talked about this digital asset thing. How can I get some? So many of us are familiar with Coinbase. It was trending as the #1 app in the US App Store, which is kind of fun. And we recommend, the team prefers Coinbase for buying right now 4 digital assets that you can purchase. And where do you store it? One option is you can leave it on the exchange. However, some people don't like to have someone else holding onto their money. So you can yourself hold onto the money through having a USB, a hardware wallet, where then you take responsibility. Now, if you were to lose this hardware wallet, you would lose all of your money. It's unclear how comfortable people will be putting $100,000, $10,000, $1 million on a USB drive and saying that that is money. That's an uncomfortable feeling right now. Another option is to print it. You can literally print QR codes, put it in a safe deposit box, for example, and that is a form of money now. Now I'm going to pass it off to Ben, who's going to go into more detail around what Bitcoin is.
All right, hi guys, I'm Ben. So what is Bitcoin? Bitcoin is a decentralized digital money. Decentralized meaning that it has no central body or firm watching over it and no single point of failure. Digital meaning that's completely online, and money meaning that fulfills all the requirements of money. Bitcoin was founded by Satoshi Nakamoto, but nobody actually knows who Satoshi Nakamoto is. It could be a single person or a group of people, but Satoshi was very good at covering his tracks online and disappeared in 2009. Transactions sent on the Bitcoin network are simple peer-to-peer transactions. This means that there is no other organization needed to help facilitate transactions between two people. This also is important because other types of cryptocurrencies can help facilitate different, more complicated types of transactions, as you'll see later on. Before I talk about Bitcoin's proof of work consensus method, I need to talk about Bitcoin mining. And I'm going to quickly use gold as a metaphor. Part of what makes gold such a good store of value is its scarcity. You can't mine new you can't mine new gold without doing the work required to mine it. Bitcoin is similar to this. However, instead of spending time and money, Bitcoin miners must spend mainly electricity and computational power to mine Bitcoin. This is because in order to mine Bitcoin, you must solve a complicated and expensive mathematical function called a hash function. And this is where proof of work comes in. Bitcoin miners that solve the hash function prove that they've done the work required to mine the new Bitcoin, hence the name proof of work. But consensus is actually how a cryptocurrency comes to agree on where all the currency in the network lies. So why is Bitcoin's consensus method considered proof of work? The answer lies in the blockchain. And this is what makes Bitcoin so revolutionary. The Bitcoin blockchain is essentially a digital public ledger where all the Bitcoin in the world is accounted for. And this is what part of the blockchain actually looks like. On the left are the addresses, and on the right is the Bitcoin stored at each address. In solving those hash functions I was talking about earlier, Bitcoin miners are coming to a consensus basically about where all the Bitcoin in the world is stored at, while also still mining new Bitcoin. This is why Bitcoin's consensus method is considered proof of work. But this system is not perfect. With the recent rise in Bitcoin's popularity, the network has gotten bogged down, leading to slow transaction times and high transaction fees. It's also worth noting how new Bitcoin comes into the network. So metaphorically speaking, if the Bitcoin blockchain is a digital ledger, then the blocks on the blockchain will be similar to pages in that ledger. And every time a Bitcoin miner solves a hash function, they add a block of transactions to the blockchain. But the reward they get for doing that gets cut in half every 4 years, or roughly every 210,000 blocks. So this is a graph showing that. Right now, it's at about 12.5 blocks, or 12.5 Bitcoins for every block added to the blockchain. This means that eventually, there will be no new Bitcoin entering the system, and that date is set for 2040, when there will be 21 million Bitcoin in the network. The current price right now is about $15,000, and Bitcoin hit almost $20,000 on its last run, which generated a lot of media attention surrounding Bitcoin. It's probably why you're sitting right here today. And it also generated an enormous amount of wealth. Okay, now I'm going to hand it off to Ali to talk about hard forks.
All right, hey guys, my name's Ali, and I'm going to be talking about hard forks. So what is a hard fork? A hard fork is essentially a software upgrade that is not compatible with older versions of the platform. So it's essentially a software update. But the main thing to note about a hard fork is that the community does not agree entirely about what that update should be carrying forward. So there's an update in mind, and the community does not have a consensus on whether that should carry forward. What does that look like? So here's the chain for a specific platform, and you can see each block represents some transactions going through. Right at the dashed line is where developers are going to implement a new update to the software. And so the chain forks because the community doesn't agree on what that update should be. So an original chain carries forward, which does not have the update or has what the majority of the community decided on. That's what the original chain has. But the new chain has the update that the minority of the community agreed on. So to put this into perspective, this is exactly what happened on August 1st, 2017 with Bitcoin and Bitcoin Cash. So Bitcoin hard forked, and as a result, there's the Bitcoin that you know of today with 1 megabyte blocks, and Bitcoin Cash, which is the same concept, but it just has 8 megabyte blocks. And so something interesting about when it hard forked is whoever was holding 1 Bitcoin would receive 1 coin of Bitcoin Cash as well, right at that block that's stated right there. So now it's important to note that there are 2 separate currencies. After the hard fork, the result is Bitcoin Cash and Bitcoin. They're different now. The market cap, which is the total circulating supply times the price, for Bitcoin Cash is around 40 billion, which is a lot in comparison to other cryptocurrencies. But as you can see, Bitcoin has around 253 billion as its market cap, which is significantly higher, which just proves that majority of the community supported Bitcoin in the hard fork and did not go with Bitcoin Cash. But as again, the block size for Bitcoin Cash is 8 megabytes. So you might be wondering why. Why was there even a need in the first place to update the platform? Why would you update the Bitcoin protocol? And the answer to that is scalability. Scalability is the ability of a product to function with increased demand, with increased user base. How is the product going to continue to function consistently? And so many of you may understand that Bitcoin gained a lot of users in the past year. And so the developers were racing to understand how they could accommodate this new user base. The developers even have a vision for where they see Bitcoin going. Can it even compete with the Visas of the world? Now, to put it into perspective of where Bitcoin lies, or where it was before the hard fork, it was sitting around 7 transactions per second. Now, at the same time, Ripple was around 10,000 transactions per second, and as you can see, Steam was around 1,000, which is significantly higher. And it's important to note that Visa, at its peak, can handle around 65,000 transactions per second. So obviously, Bitcoin needs to accommodate and increase its transactions per second in order to compete with the other cryptocurrencies. So there's 2 schools of thought that we're going through at the time of the hard fork. There was the block expansion. Block expansion was by the Bitcoin Cash community, and their main priority with implementing block expansion was to enable fast and cheap payments, to make Bitcoin Cash something that is a fast network, something that people can use without congesting the network and make transactions go through fast. But the Bitcoin community saw that the Lightning Network protocol was important to implement. And a little bit about Lightning Network, you can just search that up. It's very technical, but basically it's a long-term fix to help Bitcoin serve as a medium of exchange in the future. A little bit bigger of a vision than what Bitcoin Cash might have. And so at the end of the day, they're 2 separate currencies, Bitcoin Cash and Bitcoin. The communities for each currency feel as though they're doing what Satoshi Nakamoto had in mind when he first wrote up the white papers. But since he's no longer around, it's impossible to know which is the right currency in Satoshi's vision. And so it's up to the crypto community to decide what they think is important and move forward with that. Thank you.
Hello? Hi, guys. Okay, so I'm Briana, and I'll be talking a little bit about Ethereum. And so Ethereum is actually, once again, the world's 2nd largest cryptocurrency to date, according to total market cap. So let's compare it a little bit with Bitcoin now. So the concept of Bitcoin is digital money, and so each block holds a financial transaction. With Ethereum, it's a decentralized platform that runs smart contracts, and so each block holds a smart contract. So smart contracts are these self-executing contracts with terms of an agreement between a buyer and a seller directly written in lines of code. And so the beauty of a smart contract is that it works in a trustless environment. And so once conditions in the code are met, it self-executes without the need of some central governing authority. Okay, so let's use an example. So let's say Bob is currently a University of Michigan student, and over winter break, he went home to his mother, Alice, and asked for some money because he was low on cash. He asked her if she could transfer some money into his digital wallet. So Alice has a feeling that Bob may not be truthful. He has a history of saying that he was low on cash, but he really wasn't. And so she says, okay, Bob, I'll transfer you the money only if these conditions here are met. So if you go back to campus, which is today's date, and your balance is less than 10 ethers. So lo and behold, Bob's balance met the criteria. The date is January 8th. Bob's balance less than 10. And the funds automatically transfer into Bob's digital wallet. Okay, and then for all you CS students out here, here's a little code snippet to show you the behind the scenes of what a smart contract would look like. So Ethereum was released a couple years ago in the summer of 2015 by a guy named Vitalik Buterin, and he was about 21 years old at the time of the release. And this is what he looks like. And now he's still very engaged in the whole crypto community. He actively talks on social media and shares his insight and constantly develops and makes updates to the Ethereum network. And what I love about this picture is that he's speaking at this major tech conference and he's wearing this unicorn llama rainbow shirt. And I think that's a testament to how quirky he is, but also, you know, how much of an influence he is in this whole crypto space. Okay, so then now back to Ethereum. So Ethereum is able to track state between applications. And so in a lot of industries, this reduces the need for complex paperwork, reduces error in transactions, and what it ultimately does, it reduces the need for middlemen in many industries. So this is the application of Ethereum in the business world. So hundreds of industries are going to be affected in some way, including real estate, finance, banking, and insurance. So now let's go into a real-life example. And this is for simplicity purposes, let's use a very simple example. So let's say the dean of the Ross School of Business, Dean DeRue, is thinking about buying a pizza. And he orders from Domino's. And Domino's previously had this policy where if they didn't deliver the pizza under 30 minutes, the pizza would be free. Doesn't exist now, but let's pretend that it still is a thing. And so let's also assume here that both Domino's and Dean DeRue both agree to use their phone GPS as a data source so that people on the network can track where they are and see where they are in the whole network. And so then, with this smart contract, if Domino's is able to deliver the pizza under 30 minutes, then this contract automatically executes and Dean DeRue pays Domino's. So what else is Ethereum good for? So the platform of Ethereum is great for launching ICOs, which are initial coin offerings. And ICOs have been gaining a lot of media attention recently. ICOs have surpassed venture capital funding in terms of cumulative funding in this past year. So to explain what ICOs are, so if you are a business or a startup and you're looking to fundraise, traditionally you would go to a venture capitalist firm, pitch your idea, they would give you funds, and in exchange they would take a stake out of your company, some equity. With an ICO, it's another method of fundraising via cryptocurrency tokens. And so as a startup, I would issue a token, one of my own startup's token, in exchange for Ether or Bitcoin. And all you need to launch an ICO is a white paper, which is essentially a business plan. There's an abstract in the beginning, you define the problem, and then you explain your proposed solution. And it's a balance of both like technical and conceptual explanation. So now I'm going to talk a little bit about ICO misconceptions. Generally, I've heard a lot of people say that ICOs are like a digital IPO, and IPO is initial public offering. They sound the same, but this is not true. So an IPO is the first sale of an issued stock by a company. So you're issuing a security. An ICO, that's not the case. You're not buying voting rights in the company, and you're not buying a stake, any equity in the company. What it is that you're buying a token that has some intrinsic value within the ecosystem of that startup. A little bit nuanced. A couple other things is that it's cheap and it's easy to launch an ICO. And these are also not true because now ICOs are starting to cost anywhere between $100,000 to $500,000 just to launch an ICO. So now startups are having to do a pre-ICO to raise enough funds to launch their actual ICO. And it's also a very difficult and complex process. And just to recap, we talked about Ethereum, what it does, how smart contracts work, and then what initial coin offerings are. And now I'll pass it on to Andy.
All right, let's talk about Litecoin. So Litecoin is a very similar concept to Bitcoin. It was one of the early forks of Bitcoin in October of 2011, and it was created by Charlie Lee, an MIT grad who worked as a software engineer at Google and later at Coinbase. Charlie Lee thought Bitcoin was too slow and expensive, so that's why he decided to create Litecoin. To understand Litecoin, let's show an example of the blockchain. So here's a block with all the information that's passed on. You see the transactions and then 2 hashes, which I'll talk more about very soon. Every time you add a block to the blockchain, on the Bitcoin network, it takes 10 minutes to process those transactions. If you want to add that on the Litecoin network, it only takes 2.5 minutes. And this stays true every time you add new transactions through another block to the blockchain. So why did Charlie Lee want to do this? Charlie Lee thought that Litecoin could be the silver to Bitcoin's gold. The same way that Bitcoin is kind of like gold, where it's a store of value and it stays in a safe, not to be used too often, Litecoin is more like silver, a coin that would be used in everyday transactions so that you could buy goods with it and use it more often. This is possible because Bitcoin can only process up to 7 transactions per second, whereas Litecoin can process up to 56 transactions per second. Now we'll talk about hashing algorithms. First of all, a hash is a combination of random letters and numbers of a specified length that represents a bunch of data. So this data here is in a block. The data that you're trying to process is a list of transactions, the previous block's hash value, and a nonce, which is a random number which will identify that certain block. Something important to note is that I put 4 numbers here, but the nonce may actually be much longer. So when you run a hashing algorithm on all of this information, it creates a hash, which you see right here on the right. Every time you change a value inside of this data structure, you'll get a different hash. So the idea is that miners would change the nonce, and it would change the hash here. The important thing about mining is that you need to find the value that has a certain number of leading zeros in the hash. So they'll try billions of different nonces until they get a hash out that actually serves these characteristics. For Bitcoin, you need 18 zeros. But for the sake of this example, we'll say you need 5 zeros to find the hash value of this new block. So we change the nonce, and the hash value changes. We change again, and now we can see that we have 5 zeros. So this fits the description. This here on the right will be the new hash for the block. Now, when you're running billions of these nonces, it's important that Litecoin can process this hashing algorithm much quicker than Bitcoin can. Litecoin's hashing algorithm is called scrypt, which moves much faster than Bitcoin's SHA-256 algorithm. Another important thing to note is that it uses way less calculations, so it uses less energy and therefore is much better for the environment than Bitcoin's. It's also still efficient without a $5,000 to $10,000 specific mining computer. So for Bitcoin, you need to pay a lot to be able to efficiently run these hashing algorithms, but Litecoin, you can still run it from desktops at home. The market cap for Bitcoin is 253 billion as opposed to Litecoin. Sorry, Bitcoin's is 253 billion as opposed to Litecoin's 14 billion. There's 4 times as many Litecoin out there as there are Bitcoin once all of them are released, and the price is much cheaper at 254. Now I'll pass it off to Matt to talk about Ripple.
Hey everybody. I'm just going to give you a quick overview of Ripple. Ripple was created in 2012 and co-founded by Jed McCaleb and Chris Larson. Jed McCaleb also created Mt. Gox, the first ever crypto exchange, and also was involved in Stellar Lumen. So he's really been part of this space since the very beginning. The main concept is global payments, and has established a really high market cap, and is currently trading at $2.49. What is Ripple? Ripple, when a lot of us think about it, we think about the coin that we can invest in online or whatever, but really it's a private company that employs, that has this technology called RippleNet. It's the blockchain technology that allows its customers to send payments at a cheap price and very efficiently. And that's really the core value of what Ripple is, not the currency, not XRP. XRP is really just a token that is exchanged on the blockchain that they've created. So really what we see the value in is the company, and that's why we see a lot of VC flooding into Ripple. Some big names like Accenture, Andreessen Horowitz, and Google Ventures have all invested in Ripple, as many more. And they've currently amassed $93.6 million in total funding. It's really set them off to a good start to really establish themselves as a great company going into the future. My personal story, I lived overseas in China for about 8 to 10 years, and we've always had trouble as a family sending money overseas via our bank account to maybe a friend or relative in the U.S. And Ripple's trying to solve that problem. Behind me is the typical transaction process you might see in the past. Say you're starting off with Mexican pesos and you're trying to turn that and give that to somebody in Korea through the South Korean won. You're going to have to trade that through, in the past you're going to have to go through US dollars, then Japanese yen, then South Korean won. But Ripple's trying to solve this problem by just cutting out the middlemen, being more efficient, lower costs, in a quicker process, just going straight from pesos to the South Korean won. So a lot of us, I'm sure just from this graphic, can really see the value of what this can provide for going into the future for in regards to banks or payment processors trying to send money. And banks do see this, and you see a lot of big-name banks getting in, accepting Ripple as part of their business plan. You see UBS, RBC, American Express, Bank of America, and many more. So it's interesting to note that as well. And that really what they're seeing is all the benefits of Ripple. It's fast, averaging about 3.3 seconds per transaction. It's cheap, about a penny per transaction in fees. And it's very scalable, about 1,500 transactions per second. And you can compare that to Bitcoin 7, and I think Litecoin's 56. So just as a comparison, but yeah, thank you.
So next up is Monero, and I like to think of Monero as kind of the next step in the evolution of digital currency. It has the same use case as Bitcoin and these other hard forks, as in it's used for digital money. But where the other hard forks focused on the speed of the transaction, Monero wanted to focus on the privacy. So a lot of people talk about, yes, Bitcoin is private, but it really is not as private as you think it is. So we had an example of what a block would look like for other blockchains. For Monero, this is literally what it looks like. You don't know who's sending what to who, and you don't know what the amount is. The other big part in this for Monero is fungibility. And so if I have a friend, Will, and Will has a $100 bill, and I have a $100 bill, they're identical for all intensive purposes. There's no history tied to the $100 bill. You can't trace the $100 bill back to see where it was used. Now, this is a critical part of any currency. And Monero has this, and not a lot of cryptocurrencies have this effect. Bitcoin does not. So you can trace Bitcoin's history back to when it was very first mined. And this brings up a lot of legal and ethical questions. If you purchased a Bitcoin legally on an exchange, but let's say in 2 years people are able to trace its history back to some illegal activity, there's really no legal precedent for whether or not you can keep it or what the government can and cannot do. So if a Bitcoin is used in illegal transactions and its history is filled with that, there is a big question on what are the legal implications of being able to see the history of where it has been used. And this is where Monero comes in, because Monero is identical. 1 Monero equals 1 Monero. There's no history. There's no past transaction. And it is one of the leading privacy coins in the race to be a digital currency. This is kind of a nice graphic to show like the 3 key components. You have something that's decentralized. You have something that is private, which is gold. You have something that is decentralized and digital, which is Bitcoin. And then kind of Monero really fits all 3 because it's private, it's digital, and it is decentralized. It's not owned and it's not run by any single entity. With Bitcoin, you have a public wallet address. And that is only yours, and only you can use it. And so this brings up a lot of questions, because when we think of currency, it's like, if Bitcoin really does what it could do in replacing kind of the way we exchange money, then that kind of means I can peek into anybody's wallets. So if I gave Will money and we exchanged something, I can literally go to Will's wallet, and I can see what Will has been buying. I can see how much money Will has. And all that information is public. Although wallets are a series of numbers, the moment that I can identify you to those numbers, then none of this is anonymous. And that is a key factor in kind of this race to see what digital currency is going to be widely adopted. And just to get on the tech behind this, the way it does it is by using public-private key encryption, but it uses temporary keys. So with Bitcoin, you can print out your key, and it is your private key, and like Danny mentioned, you can put it in a safe. But with Monero, it's a little bit different, because we need this level of, to be anonymous, it needs to be completely temporary. So that's how you're able to hide the money that you're sending, and you're able to hide who you're sending it to, and you're able to hide when you're sending it. Now, there are legal implications to this, of course. Bitcoin has a history of being adopted by the dark web before mass adoption. And in fact, the dark web has unadopted Bitcoin. Monero is being used by the dark web right now and is gaining popularity, not just because of that, but also because people value privacy. And privacy is extremely important. The one flaw in Monero is that if I send a transaction from right here, you would be able to trace me back to here. My IP address is still public. And in the next couple months, Monero is going to be rolling out a hidden IP service, which would essentially be the final step into making Monero completely private. So where you send it from is private, who you send it to is private, and how much you send is private. And that's a brief overview of Monero.
Hi everyone, my name is Derek, and I'm going to talk about Dash. So Dash is kind of similar to Bitcoin because Dash is also aimed at becoming a form of payment, but it's going to improve its user case in the retail scenario. And in the retail scenario, what's most important? Speed, right? If you go buy a coffee, you're not going to stand there and wait 30 minutes for your confirmation to go through. But on top of speed, Dash also offers other functionalities, such as privacy as well, and Dash can also self-fund its future development. But before diving into these features, I wish to take a closer look at the infrastructure. I like to say what's the structural difference between Bitcoin and Dash. So on Bitcoin network, who is doing all the maintenance work of the blockchain? Only the miners, right? And what does miner do? So miners, they're going to write the transaction to the blockchain through mining. And they can reach consensus through mining. And this process of reaching consensus, this mining process, is extremely time-consuming and energy-consuming. It takes a long time. So it takes them a lot of time to make a decision whether a transaction is valid or not. However, on Dash network, you have two types of loads. You have both the miners and the master loads. So what the master loads do is that the master network, they communicate to each other and make decisions through voting. Because they do it through voting, it's much faster than the proof of work. And some of the features they can offer, some of the services they can offer, instant send, private send, and they also do a self-governance of the Dash Foundation. And so here is how the mining reward distribution is for Dash. For Bitcoin, 100% of that mining reward goes to miners. But in Dash, 45% of that reward goes to miners, and Maslow is going to take another 45%. And another 10% goes to Dash Foundation, which I will elaborate further on where that 10% is used for. So some of the features of Dash are instant send, private send, and self-sustaining funding. So instant send, if you use instant send, the transaction will just go through literally in seconds. And to use this on the user's end is extremely easy. Just check this box here. Use instant send, and then this transaction goes through as an instant send. And why is an instant send fast? So let's take a look at what does a long instant send work. So your transaction is first picked up by the miner, and then the miner is going to do all this proof of work stuff. It takes a long time. Then your transaction gets written on the blockchain. Only at this stage, it can be considered that this transaction is validated. So you have to wait all the way till your transaction gets written on the blockchain. Then you can say your transaction went through. But with an instant send, your transaction is first picked up by Maslow. So Maslow, they're going to do, they're going to reach consensus through voting. And if the Maslow network, they agree that your transaction is valid, you have enough fund, then you can just consider your transaction went through. So at this stage, you can already consider your transaction is confirmed. You can walk away with your merchandise. So that's why the Dash instant send works faster. And private send. So now let's first think why, how do we trace some Dash address back to a specific person, right? That's because people might post this address on their social media. So that's how you link a specific cryptocurrency address to a specific person. So in regular Bitcoin transaction, it's pretty clear once you know who is behind this address, you can link that back to a real person. You can say this person sent five Bitcoins to this person. But if you use a dash private send, it's going to take 2 steps. So the first step, the match nodes is going to find other people who are wishing to do the similar private send transaction. And then all of these people, they're going to create new addresses. So these new addresses are unknown to other people. They don't if you don't publish this new address on your social media, then nobody can link that address back to you. And then they're going to do a shuffle send. So Alice is going to send to Bob's new address, and Bob is going to send to Cindy's new address, and Cindy is going to send to Alice's new address. So after this step is done, all of these new addresses, they're going to have exactly 1 dash on each of the account, right? However, this new account X, it cannot be traced back to Alice, the person. Like, if you look at the blockchain, it's going to look like this. Address X, send 1 dash to this specific person, but you cannot tell who does this X address belong to. And then the last, self-sustaining funding. So on Bitcoin, 100% of the reward goes to miner, but on Dash, 10% goes to foundation. And what does the foundation do with that 10% Dash? Use the 10% Dash to promote the future growth of the cryptocurrency. Use the 10% to hire programmers. Use the 10% to hire marketers. To run campaigns to sponsor people to go to different conferences. To promote the future use of this digital currency. And that concludes my presentation about Dash. And next.
All right, hey guys. I'm Andy, and I'm going to be talking to you guys about NEO. So, NEO was founded in 2016 by Dahong Fei and Eric Zhang, who are 2 graduates of the South China University of Technology. And Dahong Fei worked as a tech consultant for several years before reconvening with Eric Zhang to work on what is now called NEO. It was then called AntShares. And unlike Bitcoin, NEO is more than just digital money. So, like Ethereum, NEO is a platform for building decentralized applications. However, NEO's goal is to help individuals and institutions digitize their physical assets and then to secure them, trade them, buy them, and sell them in the virtual world. The founders of NEO believe that as our economy becomes increasingly digital, that we need to secure and build blockchain-based commerce to move towards what they're calling a smart economy. So the way that NEO aims to digitize our assets is through smart contracts. And a smart contract, like Briana talked about, is just basically a transaction that only activates given a certain condition. So on the Ethereum platform, in order for a developer to build smart contracts and other applications, they need to learn Ethereum's old programming language called Solidity. They only have 1 option. However, on the NEO platform, they have one of 10 options, including Java, C#, Python, and Google's Go, all very common in programming languages. By offering so many options to developers, NEO is really lowering the barrier for people to start developing on their platform, hopefully leading to growth in the future. So while developing on the NEO platform is definitely accessible worldwide, most of NEO's core developers, corporate partners, and support in general hails from China. So this is contrasted with Ethereum, whose core developers hail from all over the world, and they have corporate partners from all over. The Enterprise Ethereum Alliance features companies like Intel, JP Morgan, Credit Suisse, and BP, so they're all over the world. Another key takeaway is that the NEO network relies on 2 different coins. NEO, which we've talked about thus far, as well as NEO gas. So you might be wondering, what is this gas? This gas is just like what you put in your car. If you want to go somewhere, you have to expend gas. The same thing is true with NEO. If you want to make any transaction on the NEO network, you're going to need to expend gas. And gas is issued as a dividend to people that hold NEO. And it can be traded and bought on exchanges just like any other cryptocurrency. The one catch that is NEO is not divisible. It has to be moved in whole numbers. Gas, unlike that, is fractional just like Bitcoin and many other crypto assets. So the main purpose of gas is to activate these smart contracts. And in order to put a smart contract on Neo's network, similar to the example that Briana showed with Dean DeRue, you need gas because there's both a deployment fee and an implementation fee. The implementation fee varies based on the amount of computing power that you need for your transaction to happen because it's not happening locally on your computer. So really, the takeaway here is that gas is powering these smart contracts, and the smart contracts are what is helping Neo to achieve their goal of creating a smart economy. Thank you.
Hey guys, how's it going? I'm going to give you guys a little brief intro into IOTA. Basically, one way you can think of IOTA is that it's kind of like Ethereum in that it's used to build other applications. So with Ethereum, you can build other dApps. With IOTA, you can build stuff on their platform. But where Ethereum is trying to do for smart contracts, IOTA basically wants to be the backbone for the Internet of Things. And so the way they're going to do this, the way they've been going about this, is that instead of working on the blockchain, they actually decide, hey, let's create our own thing. We'll call it Tangle, and yeah, this is going to be our custom function for what's going to be the backbone of the Internet of Things. And one thing that's really helpful when you're trying to be the backbone of the Internet of Things is to have something with no transaction fees. And so how do they have no transaction fees, but Bitcoin has transaction fees? Well, with Bitcoin, typically what happens is to verify a transaction, you have these miners. They mine the Bitcoin, they verify a transaction, they get paid in Bitcoin, then they also get paid a transaction fee. With IOTA, there's no such thing as mining. So you have to think to yourself, how is everything going to be verified? How do people go about verifying these transactions? And well, so there's a completely fixed supply of IOTA. It was all put out in the beginning, and then they never created any more, nor will any more come out. And so what happens is you actually verify your own transactions. Better. You don't verify your own, but you verify two other people's. Whenever you make a transaction, you verify two other people's. So the users are the validators in that sense. There's no need for miners. There's no need to pay them a fee. So it's feeless. Now, another really interesting thing, another cool problem that it's solving is that it's quantum proof. So what is quantum proof? Why do we care? Basically, there's this threat, there's a risk that quantum computers are going to be able to hack the Bitcoin network, the Ethereum network, all blockchain, cryptography, and it's basically because quantum computing can operate at a much faster speed, a much faster computational speed, but IOTA fixed that issue, and they're quantum proof, so that's not a threat right now. So they were created about a year and a half ago. They sit at around $4. They're the 9th largest by market cap, but like I was saying, the real interesting thing about what makes IOTA IOTA is that they created their own blockchain. Well, not their own blockchain, their own form of cryptography, and that's called the Tangle. So this is what the Tangle looks like when you compare it to Bitcoin. It's a little different. Bitcoin, you can see it's a little bit more linear, whereas Tangle, it's all over the place. You have different transactions, those little squares, those are all different transactions, and they're all over the place. And so this is what it looks like in live form. So you see all these new dots being created, those are new transactions, and then they attach to the rest of the network, and that's basically them verifying all the other transactions. So why do we care? Cool, right? So with a couple of benefits, number one, it scales completely linearly. There's a huge issue with blockchain and in Bitcoin that there's this trade-off where the more users you have, the more transactions you have, the higher the latency, the slower the system. You know, it doesn't work out that way. So how are you going to scale completely all the way up to the top and have the world using it? Can't. Because there's this linear scale with IOTA's Tangle, it makes it so that it can be fully adopted by anyone and solves a really big issue with the blockchain. Another big benefit is, like I was mentioning, the transaction fees. So since there's no transaction fees, if I wanted to send, let's say, $1 million to you in the front row, you're welcome. So basically what's going to happen is I might be charged a transaction fee. It could be maybe 20 Bitcoin. I'll take it, don't worry. And that's, that's fine. It's a drop in the bucket. But now let's say you want to transfer 20 cents. I'm going to give you 20 cents. It's going to charge me $20. Doesn't really make sense, right? Why would you do that? But now you can also say, why would anyone transfer someone 20 cents? Well, with data, if you're going to sell individual pieces of data, you can do that for pretty cheap. You can buy and sell data for pretty cheap. And IOTA actually just created a data marketplace, and they're working with the likes of Samsung, Bosch, Microsoft, and a lot of other really big players. And basically what they're doing is they're taking data that's now once in silos. All these companies, they have their own sets of data. And what's crazy about this data is that a vast majority of this data is actually completely untouched. They don't use it. They don't care. They use some of it, and it's really useful, but the others, it's untouched. And so how do you get this data from them to another company who would pay a lot of money for it, but they probably wouldn't pay a lot more to hire the developers to go get it? Well, you create a data market. And so in this scenario, you can actually have microtransactions which enable people to buy individual pieces of data from each other. Companies can sell it to each other. You can even buy it from you. So here you have demographic data, you have data from your computer, your phone, your browsing history, your transactional data, Facebook, Google, whatever. And all of this can be bought and sold on a market. So let's say you want to sell your demographic data, but not your transactional, not your computer, just want to sell your demographic data. You could actually go and make $10 a month in the future. You can make $10 a month for your data that right now all of these other companies are profiting off of. That's pretty cool. Another cool thing they're doing is something called smart charging. And so this is basically within the realms of smart cities. Imagine a future where all vehicles are electric vehicles. And they get powered from a grid. Maybe it's from solar power, maybe it's from a windmill. They're getting power from a grid, though, and it can be powered wirelessly. And so every time you get some energy from this grid, you're going to pay them some money for it, just like you pay for gas. So now imagine this scenario, but with every kind of connected device. So you go to your home, you drive back to your home, your car is filled up on electricity from the grid, and once you get home, you turn on the lights, and that light is now powered by your car, from the electricity in your car. You turn on your laptop, and it's plugged into a socket in your house, that's powered by your car. Your lamp, your Alexa, home, whatever, all of that is going to be powered from this electricity that's being transferred, but they all need to create these microtransactions to transfer 20, 30 cents for each of these transactions. And so being a feeless platform, IOTA enables that. Another scenario is you're going to a concert. You know, you're driving along the highway, there's a bunch of lamps. Each lamp is getting energy from each car that passes by. Maybe it charges you 1 cent, or you charge them a cent. You can actually make some money off of it. It's pretty cool. But then you get to the concert, all the lights, the guitars, everything that's going on in the concert, that's all powered by your car as well. And everything from your car is being powered from the grid right next door. And so basically in the future, we're going to see a lot more connected devices. And that's what IOTA is here to do. They're here to be the backbone of all of these connected devices. Anything from your Alexa to your smartphone, to your smartwatch, to your refrigerator, your lamp. Really, everything is going to be connected, and they're going to be sending each other data. And to do that, if there's a cost to it, if you want to make some money off of it, you can do that with IOTA, and they want to be the backbone of this economy. And as you can see, the Internet of Things is really exploding right now. There's a lot more connected devices that are coming on the network. And in the future, it's just going to explode at an exponential scale. So this is why IOTA wants to become the backbone of a really big part of our economy in the future. Yeah, that's basically it.
Hi, everyone. So everybody's talked about really big cryptocurrencies so far, top 10, top 25 market cap coins. But I'm here to talk to you about Vertcoin, which is a much smaller coin. And so through it, I'm going to tell you a story. So back when Bitcoin was created in 2009, everybody could mine Bitcoin. You know, the guys sitting in the front row with their laptops, they could easily mine Bitcoin right now. You know, there's a couple thousand people using the network. And then somebody figured out you can use one of these to mine Bitcoin. And it's not coincidental that a lot of people who mined Bitcoin in the beginning were gamers because they used this, a graphical processing unit, which everybody has on their computer. Most gaming computers have something that looks like this, which has a fan on it. You know, it's used for doing some of the intensive game, So, you know, they're not very expensive. They're pretty cheap to use. And then Bitmain came around in 2013. And this is a big problem because they can develop something called an application-specific integrated chip. And so it takes people like me and everybody in this room who wants to mine cryptocurrency, you know, spends $300 on some mining equipment, and now they pump it up to $5,000. And also, on top of this, they own all of these miners. They can mine as much of the Bitcoin network as they want. In fact, they actually own 30 to 40% of all Bitcoin mining transactions. So this is not good for people like me who have one of these, which equal 10,000 of those equal one of those. So that's really bad for me. And so this is bad if you want to mine Bitcoin. It actually became infeasible to mine Bitcoin in about 2013 with a graphics card. So unless you buy something, one of those ASICs from Bitmain, you just can't mine Bitcoin. It's not cost effective. You actually spend hundreds of times more in electricity than you do mining. So then Vertcoin came along in 2014, and see, their idea was to make a hashing algorithm, like everybody talked about. Every different cryptocurrency has their own hashing algorithm. It's called Lyra 2, and basically it only allows you to use GPUs to mine cryptocurrency. So, you know, this is great because people like me have the same advantage as people like Bitmain, and so this solves two problems. One, Bitmain now has no economic advantage to mine Vertcoin, so they're going to stick to mining Bitcoin because they have all the hardware to do it. And so people like me and you guys, we all can mine Vertcoin because we're all just competing against each other. We don't have millions of dollars. We don't need to spend millions of dollars. So it then creates this decentralization of the cryptocurrency. And if you look at Bitcoin's top wallets, there's like hundreds of thousands of Bitcoins in the top wallets versus Vertcoin, where the top wallet only controls about 1% of the total, all the Vertcoins in creation. And then also Vertcoin is the first coin to make an atomic swap with Litecoin. And what this does is it allows me and somebody who else has Litecoin to directly swap it without using an exchange. And so why is this valuable? Because if I want to go through an exchange, it can cost time, it can take extra money, and you know the exchange takes a fee. But I can set up an escrow service between me and somebody who has Litecoin, and we can directly transfer it between each other. And so if I have Vertcoin, they get Litecoin, or my Vertcoin, and if they have Litecoin, I get their Litecoin. And we don't have to use any third party. And then Rishi has some stuff to talk about. Finish it up.
Hello, everybody. My name is Rishi. Before I finish the last portion of this event, let's give everybody a round of applause who presented for all the hard work they put in. So I wanted to shift the focus away from all this excitement and sort of take a look at the other side of the coin, so to speak. So everybody these days is asking each other, should they invest in cryptocurrencies? And you know, should I buy Bitcoin right now? Is now a good time to sell my Litecoin? And this seems to be the narrative today and how it largely feels. We tend to be this guy on the right, and this is really why we started WCT. We wanted to explore the underlying value inherent to these digital assets, and while it's easy to get caught up on the price action, we don't find that all that engaging. So I'd be remiss if I didn't mention the importance of doing your own research, especially in these markets. So we like to describe these markets as being irrationally exuberant. And irrational exuberance is a term coined by Federal Reserve Chairman Alan Greenspan in a famous speech he gave during the dot-com bubble of the 90s. And it was essentially meant to be interpreted as a warning that the markets might be overvalued. We also believe that in the short run, there tends to be extreme volatility as the fear of missing out competes with uncertainty, confusion competes with understanding, and greed competes with fear on both the buyer and issuer side. And it also seems to be the reality that very few people in the media, in academia, in government, or really even buying cryptocurrencies can really understand and explain what's going on today. So in short, there's a lot of noise, and it's up to us to find signal in that noise and not take everything that we hear at face value. So while we all may believe in this technology and its potential to change the world, here's my attempt at examining the other side of the coin. So I have a tweet pulled up here by Vitalik Buterin, who Bree talked about as the creator of Ethereum. And in it, he responds to the market cap for cryptocurrencies bridging $500 billion. And he responds with one simple question: have we earned it? And he poses some revealing follow-up questions, one which I would like to highlight is how many unbanked people have we banked? And one of the promises of blockchain technology when it was first created was to bank the unbanked. It was to make financial services more open, more accessible, and more efficient. But to this day, there are still nearly 2 billion adults around the world who don't have a bank account and who lack access to even the most basic financial services. When you compare the reality of this to the trajectory of the valuations we've seen, there's a glaring contradiction between the maturity of this technology and how much we think these assets are worth. So Roy Amara was the president of the Institute for the Future, and he was famous for coining what is now known as Amara's Law on the effect of technology. And he said that in the short run, we tend to overestimate the effect of a technology, and in the long run, we tend to underestimate the effect of a technology. So while there always are, or always may be, both sides of the coin, I think one of the most important lessons to take away from today is that the price of a digital asset does not mean that the technology worked. And I think one of the most common misconceptions that I hear these days, and that we all hear, is that we all think we were right about the blockchain because the price of Bitcoin and the price of these digital assets has gone up so much. But I think if you take a step back and you really ask yourself how the blockchain or the Tangle or any distributed decentralized system has benefited society or even solved some of our most basic inefficient systems, you'd be hard-pressed to find an area of substantial change. So take everything you learned today with a grain of salt. We took very complex ideas and we simplified them for the sake of this presentation. I want to make it very clear, none of what we said was meant to be taken as financial advice. Again, we wanted to shift the focus onto the value of these assets and explain what are its use cases. So we encourage you to do your own investigation, your own research, and to visit our website to find resources and links for further reading. We also invite you to like our Facebook page where you can find information on our next event in February and all the details regarding our application. And like Danny said, there's much more wisdom and knowledge in the crowd than is up here that has been on stage. So we encourage you to stay after and talk to each other about this exciting revolution. Thank you for your time. We'll be floating around up here and outside to answer any questions. Thank you.
Hey, we're taking a team.